Cash flow statement. The Company Act requires that a cash flow statement be included as an addendum to the financial statements. This is a statement that clearly reflects the cash situation of a business. So in essence, it is a summary of the year's worth of bank transactions. Everything that happened in the bank needs to be stipulated on this cash flow statement. Information regarding the liquidity of a business is of great importance to the users of annual financial statements, because a cash shortage can cause a business to fail. By providing a cash flow statement, the attention of users can be drawn to possible shortcomings in this respect. The following knowledge is necessary to understand the procedures that are explained hereunder. The cash flow statement consists of three main components. In other words, firstly, it looks at cash flow from operating activities. Secondly, cash flow from investing activities. And thirdly, cash flow from financing activities. So it basically sums up everything that happens in a business into these three categories: operating, investing, and financing. So everything that we spend money on, or everything that we received money for, needs to be categorized according to these activities. Now, something before we start that you need to just pay attention to, we're going to focus on bank. So if you can recall what we did in clubs in grade 11, in clubs in grade 11 we also focused more on the cash. What was the cash coming in and what was the cash going out? The same principles apply. Now only we will talk about inflow and outflow in terms of cash. By inflow I mean what is increasing the amount of money in my bank. Increasing meaning coming into the bank, inflow. Outflow I mean what is decreasing the amount of money in my bank. And very important, when I want to indicate on the statement an inflow, I write the amount as normal, increasing. But when I want to show the amount as an outflow, a decrease to my bank, I will show that amount in brackets. This is a very, very, very key point to cash flow statements. So highlight that for yourself. Before we start with the explaining the different activities, it's important for you to just have a glimpse of the actual cash flow statement. This is what a typical cash flow statement will look like. Cash flow statement for the year ending 28th of February 2015. There you can see I've got three subheadings or three headings that says operating, investing, and financing. And by doing that, I'm categorizing my inflows and outflows according to these three activities. These three activities then adds up to tell me what is the net change in cash and cash equivalents. In other words, what is the net change in terms of the money I've got in the business. This net change I need to calculate again by saying, if I just consider the beginning balance for the year of cash and cash equivalents, and I consider the end balance of the year. So in other words, the change between beginning balance and end balance should again give me whatever I've calculated from the three activities as well. So we're now going to zoom in and look at each of these activities separately so that you can have a clear indication of what is operating, what is investing, and what is financing activities. I will do this over 2 videos, so please bear in mind that the first video would only consider operating activities, but then the video here after, the second video, will concentrate on investing activities and financing activities together. So let's start with the first component. The first component of cash flow, namely cash flow from operating activities, consists of 4 elements. Cash flow from operating activities, interest paid, dividends paid, and tax paid. Now let's start with the first element, cash from operating activities. Now operating activities talks about exactly that. What is the activities needed to operate the business on a daily basis? And my operating activities is my incomes and my expenses mainly. So when I talk about operating activities, I'm actually talking about all of my items that has to do with my profit, calculating my profit, my incomes, my expenses. Now this profit is calculated in the income statement. And the profit that's calculated in the income statement is not necessarily the amount represented in cash flow, seeing that some of it is polluted with adjustments. For example, accrued income and prepaid expenses. So we are looking for the monetary income, net profit. In other words, the net profit that is cash based. And we're not looking for the things that is not cash. So as well as the adjustments that's polluting my profit, also the items without any cash value, in other words, without any monetary value, such as depreciation, is causing my net profit to not be purely just cash. So through my cash from operating activities, I'm going to attempt to bring my net profit back to the cash only value. In other words, I want my net profit to show only the cash items and not the items that were not involving any cash. The Act further requires that the payments to suppliers of funds, in other words, interest on loans, and payments to the state in terms of income tax, and payments to owners, so such as dividends, this has to be shown separately on the cash flow statement. So I cannot have it part of just my operating activities. I need to show it separately. I'm going to show you how to show it separately. These principles and legal aspects are addressed by the following important calculation as a first note to the cash flow statement. So my first note to the cash flow statement is quite a lengthy one, and it's quite an important one as well. The name of the first note is Reconciliation between Net Profit Before Tax and Cash Generated from Operations. The format looks as follows. It starts with the net profit before tax. Then I add back any adjustments in respect of depreciation, so anything that is non-monetary value, and interest paid. Then I get and adding up a subtotal that says operating profit before changes in working capital. Then I do my changes in working capital. My working capital is also known as my net current assets. So that's, in other words, my current assets and my current liabilities. So I need to go and see which changes occur in my current assets and current liabilities. All of my current assets except for cash and cash equivalents. So I want to see what is the changes in terms of inventory, what is the changes in terms of receivables or debtors, and what is the changes in terms of payables and creditors. And after I've considered those changes, I add up my operating profit before changes plus or minus my changes in working capital, and then I'm left with my cash generated from operations. Now let me explain some of the key points to note number 1. Firstly, profit needs to be before tax, seeing that it does not include the income tax and the dividends, because these two payments are subtracted separately on the face of the cash flow statement. So I don't want it as part of note number 1. I want it separately on the actual face of the cash flow statement. Interest on borrowed money is added back because it must be shown again separately on the cash flow statement. So the same as with tax and dividends, I want to show it separately on the face of the cash flow statement and not part of note number 1. Also, depreciation is added back into the profit because depreciation does not bring about a flow of cash. So when we worked out net profit in terms of income statement, we would have subtracted depreciation. Because we subtracted it, we now need to add it back in. Because now if we add it back in, the effect would be as if depreciation is not part of net profit anymore. Okay, so that's why we add it back. Then the calculation in changes of working capital is made through the following basic knowledge and logical deductions. Firstly, inventory and debtors are both known as assets. Then I get my creditors, which is liabilities. Now, assets and liabilities are opposite of one another. So, with that in mind, inventory, the increase of inventory means that we have bought stock, which results in a decrease of cash. The amount must be shown in brackets to indicate that there is a decrease in cash, or otherwise known as an outflow. In the opposite to that is a decrease in inventory, indicates then that we've sold stock, therefore increasing my cash. Debtors does the same thing because it's still an asset. A decrease in debtors means that they have paid us, resulting in an increase in cash. An increase in debtors means the opposite, which then results in the decrease in cash. The amount must be shown in brackets to indicate the decrease in cash. Thus, we can come to the following conclusion. Assets, inventory and debtors, both are known as assets. From one year to the next, in other words, from the beginning of the year to the end of the year, if my inventory or debtors increased, then I will show it as an outflow. So an increase from beginning of the year to end of the year means money went out. The opposite is then also true. If it decreased from beginning of the year to end of the year, then it means that it's an inflow. So I just show it as a normal amount without any brackets. Creditors is then the opposite. Creditors says the following. A decrease in creditors means that we have repaid them, thus resulting in a decrease in cash. The amount is therefore shown in brackets. An increase in creditors, however, means the opposite, and that means it's an increase in cash. Thus, we can come to the following conclusion. For liabilities, in other words, for creditors, an increase would mean an increase. An increase would mean an inflow, right? I just write it as normal. Whereas a decrease is shown as an outflow, so I put it in brackets. That's a general rule that you can study and know off by heart. Let's practice this by completing example 6. Required. Use the given information to prepare the note of the reconciliation between net profit before tax and cash generated from operations. Note 1 on 30th of June 2015. Then they give you information. The following information relating to Absolute Limited. They give you a few balances. Additional information on the 30th of June. The net income before taxation is calculated at 930,000. The following items were taken into account in calculating the net income. So firstly, we need to complete the first line. Net income before tax. So profit before tax, 930,000 as they said. Next. The next bit, they say, we add back any adjustments in respect of. So if I go to my information relating to the net income, I will look through my net incomes and see, firstly, is there anything mentioned on tax, dividends, and interest that I need to exclude from my net income calculation. The next question that I ask myself is I need to exclude any non-monetary values. So if I look through this, I see no directors involved cash. I can leave it. Auditors involved cash. I can leave it. Depreciation on vehicles and depreciation on equipment. That does not involve any cash. So I want to exclude that or add that back in. So remember, when I calculated net income the first time around, I subtracted that from my net income. So to exclude it now means to add it back in. So my first addition or adjustment would be to add back the depreciation, and the depreciation of 25,000 Rand, 13,000 plus the 12,000. The next thing that I need to add back in is there is calculations to do with my interest, and there's two types of interest. I've got my mortgage loan and my bank overdraft. All interest expenses is excluded or added back in. So I would go and add back my interest as well. Interest expense, the 8,000 as well as the 2,400. So that gives me 11,000 that I need to add back in. So in other words, I've got my 930. I add back into it 36,000 Rand. So my operating profit before changes in working capital is then 966,000 Rand. How did I get that? By adding the 930 plus the 36,000 gives me 966,000 Rand. My next part to my note 1 is my cash effects in the changes to working capital. Now, working capital consists of inventory, debtors, and creditors. Now, even though I call it debtors and creditors, I'm actually referring to my note number 4, note number 5, and note number 9. So in other words, I'm referring to everything that has to do with inventory. That includes my trading stock as well as consumable stores on hand. Debtors, everything to do with debtors in note number 5, trade and other receivables. That includes debtors, but it also includes prepaid expenses. It also includes income receivable. It also includes deposit on water and electricity, for instance. Creditors, it actually refers to everything to do with trade and other payables. So it includes creditors, but it also includes expenses payable. It also includes income received in advance. It also includes anything that might be there in terms of salaries and wages, pension fund, creditors for salaries, medical aid fund, UIF, anything else that had to do with note number 9. Remember, it includes everything in note number 5 and note number 9 except anything to do with tax, dividends, and interest expense. Those three are not included due to the fact that I don't want to include it here. I want to exclude it here so that I can show it on the face of the cash flow statement separately. So from my information, you need to be able to extract the information that has to do with stock, and to extract the information that has to do with debtors in terms of trade and other receivables. And you need to extract the information that has to do with creditors, or in other words known as trade and other payables. So I've highlighted the green ones has to do with trade and other receivables. The red one has to do with trade and other payables, and the blue one has to do with inventory. So let's do inventory first. So from 2014 to 2015, it increased from 114,000 to 144,000. So we need to write firstly, did it increase or decrease? It increased in inventory. We need to write down what is our information that we are calculating. 144 minus 114. That leaves you with 30,000 difference. The 30,000 was an increase, and we said that if it's an increase in an asset, it causes an outflow. Then I need to go and add up all my greens. If I add up all of my 2014 greens, I see that I add to an amount of 310,000. If I add up all of my greens for 2015, it adds to an amount of 290,000. So there's a difference of between 310,000 to 290,000. So that difference, I need to say, did it increase or decrease? It decreased in value. The decrease in value was due to 310 minus 290. So from 2014 to 2015, it decreased. It decreased with a total of 20,000. Remember, it's an asset, and a decrease in assets shows an inflow. So I leave it without brackets. Then my last one, I need to go and add up all my rates. If I add up my 2014 rates, I see that I get a value of 250,000. If I add up all of my 2015 rates, I see I get a value of 205,000. Therefore, meaning that it decreased in value, decreased in creditors. In other words, it decreased from 250 to 205,000. So that decrease means that it decreased by 45,000. That 45,000 decrease means that it's an outflow. Remember, a liability that decrease means it's an outflow. Then I go and calculate it. I add up all of my changes in working capital. I add up this block, and I see that my total changes in working capital is an outflow of 55,000 Rand. So in other words, I take my operating profit before changes to 966,000. I subtract my 55,000, and then I'm left with my cash generated from operations. And my cash generated from operations is then 911,000. That 911,000, that's the amount that I would take to my cash flow statement as the answer to note number 1. Element number 2, calculation of income tax paid. To calculate the amount that is actually paid over to SARS in respect of income tax, the SARS income tax account must be reconstructed from available information that is obtained from the income statement and balance sheet of the present and previous year. Now, very important, the aim is to find the paid amount. So in other words, to find the amount that would have been my bank entry in SARS income tax. So let's do example 7 together to see how that reconstruction of the account work. On the 28th of February 2015, an amount of 51,000 was due to SARS in respect of income tax. Due to means that we owe that to SARS, so it would be a liability balance of 51,000 Rand. Then they say the next one, the net income for the year ending 28th of February 2016 is 850,000, was calculated correctly. Income tax is calculated at 30% of the net taxable income. So I work it out, 850 net income times 30% gives me 255,000 correct income tax expense. So I go and create the expense account and bring that expense amount over to my SARS income tax account. Income tax, 255,000 Rand. Lastly, they say the balance sheet as at 28th of February 2016 show that an amount of 26,000 is due to SARS for income tax. So due to means that we owe that money to SARS. So in other words, if we owe that money to SARS, it will be a credit balance again. So debit brought down, carried down, and then a credit brought down 26,000. So we've got everything in this account to reconstruct. So in other words, it's just one amount missing. So if we add up our credit side, we see that our balancing amount is 306. So we are going to try to get our debit side also to 306, and the missing information on debit side is then the missing bank information, and the missing bank amount is then the 280,000. So I know that the total amount for bank is 280,000. Please pay attention that I have written bank 3 times. 3 times because the first part would have been to pay back the balance. The second and third one would be the first provisional payment and the second provisional payment. Is it necessary for me to have 3 separate bank amounts? No, not at all. I'm looking for the total amount paid to SARS for the year. I don't care what was paid first, second or third. So you can just have one bank amount. That is sufficient. The balancing figure is the amount which was actually paid to SARS during the year in respect of income tax, and represents a decrease in cash, in other words an outflow. So it's shown in brackets on the face of the cash flow statement. The third element, calculation of dividends paid. To calculate the dividends payable, the shareholders for dividends account must be reconstructed from information obtained from the income statement and balance sheet of the current and previous years. Returns paid to shareholders consist mostly of the previous year's final dividend and the interim dividends of the present year. Let's do example 8 together to see how to calculate that. Information. On the 28th of February 2015, the balance sheet shows the amount of 67,000 as being owed to shareholders in respect of a final dividend declared. So that is a final dividend declared, not yet paid, so it's still owed to the shareholders. So in other words, it stays as a balance for the new year. March 1st, 2015, balance brought down 67,000 Rand. The total of the dividends declared during the accounting period ending 28th of February 2016 amounts to 143,000. This includes both the interim and the final dividend. It's very important. It needs to include both. So in other words, coming from the expense account of ordinary share dividends, I bring that information to my shareholders for dividends accounts. Ordinary share dividends, 143,000. Please note it is the interim as well as the final amount. Lastly, on the 28th of February 2016, the balance sheet shows that an amount of 60,000 is still owed to the shareholders in respect of the year's final dividends. So in other words, that's the final dividend that was only declared, so it will stay as a balance in this account. So I would have a balance brought down or carried down from the previous year of 60,000 Rand. That balance then is the last amount to be put into this account. There's only one bit of information missing, and that would be the balancing figure. So if I add up my credit side, I see that my credit side gives me a total of 210,000 Rand in this account. That 210 tells me that there is missing information on the debit side, and that missing information is then the bank that I'm after, the bank amount. So therefore the missing information for bank is the 150,000 Rand. That 150,000 is then the amount that I'm after. I'm looking for the cash part of dividends. Is it necessary for me to have two separate amounts? Because one was the payment of the previous year's balance and the second one was the payment of the interim dividend? No, it's not necessary, because I just need one amount to put on the face of the balance sheet, face of the cash flow statement. So let's read. The balancing figure is the amount actually paid out to the shareholders for dividends during this year, and represents the decrease in cash, in other words an outflow, and is shown in brackets on the face of the cash flow statement. The last element would be the interest expense. Now, the same way that we reconstructed tax and dividends, we can now also go and reconstruct our interest expense account to also find the missing bank figure. We are not going to look at an example together because it's very easy to do so. We will see those exercises when we get to the actual exercises. To recap, our first bit of the cash flow statement is then completed. Our cash flow from operating activities. Our cash received from operations, interest paid, dividends paid, and income tax paid. Note number 1, note number 2, and note number 3. Note number 1, reconciliation between profits. We always start with profit before tax. We add back our adjustments to depreciation and interest paid. Then we do our changes in working capital, and we are left with our cash generated from operations. Note number 2, dividends paid. We can either do it in T account form or we can do it as part of the note. The note, T account form, is entirely up to you. You can do whichever one works best for you. We've discussed the T account form already. If we quickly look at the note, amount in financial statements, so in other words coming from note number 8, the retained income note, is our amount interim and final dividends for the year. Balance owing on the last day of the previous year, balance owing for the current year, and then the amount paid to the shareholders during the year. Note number 3, again, either you can do it in T account form or you've got the choice to do it in note form. We've already discussed the T account form. Let's look at the note form. Income tax paid, amount as it comes from the income statement, is subtracted balance owing on the last day of the previous year, balance owing the end of the current year, and then the amount that was paid. In both of these instances, the amount paid and the amount paid is then the amount to be taken back to the face of the cash flow statement. And then you are done with your operating activities. So I add it all up, everything in the block, and I get one total for the operating activities.